This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 13 May 2026.
Well, I'm really looking forward to getting straight into this one.
Right, so welcome to today's deep dive. Imagine you wake up, you pour your morning coffee, check your investment portfolio, and you realize your bank has completely sold off your preferred tech shares for, well, a series of very conservative bonds.
That would certainly be a surprise.
Exactly, you'd be furious, but the real question is who is actually legally responsible there? So today we are going to systematically break down the operational and legal distinctions between investment advice and discretionary portfolio management within the Luxembourg private banking framework.
Yeah, and that is a critically important mission for us today, really, because ultimately the entire legal distinction rests on one highly specific question. Who makes the final investment decision?
Right. And, that single question dictates the entire structural relationship between the financial institution and you, the investor.
Oh, absolutely. And to establish a proper foundation here, there are basically three practical pillars that you need to keep in mind. So first, investment advice requires a personal recommendation.
Meaning the final decision to act always remains with the client. Right.
Spot on. The institution advises, but you as the client pull the trigger.
So if we use a bit of an analogy here, investment advice is like sitting in the passenger seat of a car with a map. I mean, you are giving the driver expert directions, but they are the ones holding the steering wheel and deciding whether or not to actually take that turn.
That is a very accurate way to visualize it, actually. Now, the second pillar is discretionary management. And sticking with your car analogy, this is much more like getting into a taxi.
Right, where you just give the driver your final destination.
Exactly. You transfer the decision-making authority entirely to them. They choose the route. However, in the financial world, this authority operates strictly within the parameters of an agreed client mandate.
So the manager acts autonomously, but only within those carefully defined, pre-negotiated boundaries.
Yes. And that brings us to the third pillar, which bridges the gap between those two models. And that is the concept of suitability.
Suitability. So that's the operational center for both models, essentially.
Precisely. Your client profile, your understanding of the products, the mandate itself, and the institution's internal records, well, they must align flawlessly. If one piece is out of place, the entire compliance structure falters.
I do have to ask, though, why does this distinction require such intense regulatory focus right now? I mean, from the outside, it might feel like market participants sometimes blur these lines commercially, maybe to capture different fee structures. Does that necessitate this strict legal demarcation?
Well, it is easy to view it through a commercial lens, but from a purely legal perspective, this distinction is absolutely not a cosmetic choice. It is the fundamental architecture of the legal relationship.
So the authorities require this precise demarcation to ensure structural clarity.
Exactly. If a market crashes, both the institution and the investor need to know exactly whose hand was on the steering wheel. If the lines are blurred, liability becomes a highly complex issue.
Okay, let's unpack this core regulatory framework by looking at the 5 W's and the how. Let's start with the who. If you're operating in Luxembourg, who exactly is captured by this framework?
The framework captures quite a comprehensive range of entities. So it includes investment firms and credit institutions providing investment advice or portfolio management.
And it also explicitly captures UCI's management companies, right?
Yes, exactly. Those managing standard, highly regulated European retail funds. And it also covers external alternative investment fund managers, or AIFMs, when they provide individual portfolio management or investment advice.
Right. And the main regulatory text here is CSSF Circular 23835, which principally addresses retail clients, but obviously the principles applied to professional clients were relevant.
Spot on. Which brings us naturally to the what's.
Right. For the what, we are relying on the exact definitions provided by ESMA. For those who aren't swimming in European regulatory acronyms, that's the European Securities and Markets Authority.
the EU's top securities watchdog, essentially.
Exactly. And under their definitions, investment advice is a personal recommendation to a client concerning one or more transactions in financial instruments. And that can happen either at your request or at the firm's initiative.
Right. Whereas portfolio management is the management of portfolios under client mandates on a discretionary client-by-client basis.
It is a very elegant distinction when you look at the text. One is a recommendation leading to a client decision, and the other is discretionary management.
Exactly. There is zero ambiguity in the text. Now, moving to the where. This framework operates within a very specific jurisdictional application.
We're dealing with European Union law, applied through the Luxembourg Financial Sector Framework and CSSF supervisory practice, correct?
Yes, and there is a crucial legal note here regarding the hierarchy of norms in Luxembourg. For Luxembourg laws, the journal official, which you access through the Legilex portal, remains the absolute authoritative source.
But the CSSF also provides consolidated legal texts, right?
They do, and those are highly practical working references for daily operations. They provide excellent clarity. But those consolidated texts expressly state that the journal official version is the one that prevails.
So relying purely on the consolidated texts is a bit like reading the summary notes instead of the actual legislation. It's great for daily work, but the original text is the ultimate authority.
Exactly. It's a highly functional system designed for absolute legal certainty. The CSSF issues circulars and regulations that provide necessary guidance, whilst always respecting that established legislative hierarchy.
That makes sense. So let's look at the when. The MiFID II suitability framework is actively in force.
Yes. Specifically, CSSF Circular 23835 applies the ESMA suitability guidelines, and both of those have been actively applying since 3 October 2023.
That October date is quite important, isn't it? Because it establishes the baseline for current compliance monitoring.
Oh, absolutely. If an institution's files haven't been updated to reflect those standards since then, they are structurally exposed.
Which leads us directly to the why. The policy objective here isn't just generating more paperwork, is it?
No, not at all. It is fundamentally about investor protection. When a firm provides advice or portfolio management, they must obtain necessary information on a specific set of metrics.
Right. They need to know your knowledge, your experience, your financial situation, your ability to bear losses, your investment objectives, and your risk tolerance.
Yes, the thoroughness of that list is entirely deliberate. It completely prevents assumptions.
But wait, let me just interject there. Help me understand the nuance between a couple of those. Why assess both your ability to bear losses and your risk tolerance? Don't those mean essentially the same thing?
Well, no, not at all. And actually conflating the two is a rather common operational error. Ability to bear losses is purely mathematical.
Meaning, if I have a large portfolio and I lose a portion of it, can I still pay my mortgage?
Exactly. Risk tolerance, on the other hand, is psychological. You might have the mathematical wealth to endure a loss without changing your lifestyle, but the psychological stress of that drop might cause you to panic and sell at the worst possible moment.
Ah, I see. So the institution must document both to ensure the service is strictly suitable. That makes perfect sense. So how does a firm actually execute this on a clinical level?
It is built step by step. First, collecting that detailed client information. Second, establishing a documented understanding of the financial product itself.
And then third would be formally assessing the suitability of matching that client to that specific product, right?
Exactly. Fourth is drafting the corresponding contractual documentation. Fifth, providing suitable ongoing reporting. And finally, conducting a formal cost-benefit analysis before switching investments.
Let's actually linger on that last point. A cost-benefit analysis before a switch. So if a manager decides to move your funds from product A to product B, they can't just do it because product B looks a bit more appealing today.
No, definitely not. They have to mathematically prove that the potential benefits of the new product outweigh the transaction costs and tax implications of selling the old one.
And they have to put that proof in writing before the trade is executed.
Precisely. And, translating these rules into daily execution dictates the playbook for an institution's operational reality.
Let's dive right into that playbook then. If you are operating under an advisory agreement, what does the documentation actually need to look like?
Well, it has to cleanly evidence a specific sequence of events. The file must show that the client received a recommendation, that it was suitable, and that the client subsequently made an independent decision to act.
The sequence is the safeguard, and if you are running a discretionary mandate, the taxi driver scenario,
a completely different operational posture. The mandate must rigorously define the investment universe, establish the exact risk profile, codify the absolute limits of discretion, set the reporting frequency, and define clear escalation points.
So the manager acts with autonomy, but only within a highly controlled architecture. And to maintain this, a firm has to align 3 specific layers of documentation, right?
Yes, they have to tell one discipline story. Layer 1 is the client classification and suitability file,
Which I imagine is supported by permanent structural pillars like anti-money laundering and know your customer protocols.
Absolutely, those are permanent pillars. Then layer 2 is the contractual mandate or the advisory terms, and layer 3 is the actual investment or execution records.
And if those 3 layers do not perfectly align, the structural integrity just fails.
Exactly. The suitability file must justify the mandate, and the execution records must strictly adhere to that mandate.
Let's talk about the reality of making this happen. Maintaining 3 perfect layers across thousands of clients sounds, well, incredibly resource intensive. Are the costs of this purely operational?
Yes, it is vital to clarify that costs in this context are strictly operational. They arise directly from implementation, legal review, internal controls, and file maintenance.
They are simply the cost of maintaining a safe, compliant framework.
Precisely. And tax considerations remain ancillary here, unless the investment structure itself introduces tax-sensitive governance issues. The primary focus is the disciplined execution of the regulatory framework.
And maintaining this discipline is happening while the market is naturally evolving. Firms have to monitor broader regulatory pulses to stay aligned.
Which is exactly why market practice treats the divide between advice and discretion as a fundamental mandate design issue.
The greater the discretion transferred, the higher the operational burden for the bank. Let's actually look at the current market pulse. We have 2 key regulatory updates reported by the CSSF on 12 May 2026.
Yes, the first is the publication of the Law of 5 May 2026, which amends the Law of 5 April 1993, officially transposing CRD6.
For context, CRD6 is the Capital Requirements Directive, the European rulebook dictating how banks govern themselves and manage risks.
Right, and that transposition refines the operational environment. It impacts internal governance, introduces new ESG and crypto asset risk requirements, alters third country branch operations, and expands prudential powers.
And the second major update from 12 May 2026 is a CSSF communique regarding market readiness for the transition from a T+2 to a T+1 settlement cycle.
That is a significant structural shift.
Yeah, let's translate the jargon for a second. Currently, when you execute a trade, the actual exchange of cash for securities settles 2 business days later, which is T+2. The market is compressing this to T+1, settlement the very next day.
And losing that 24 hours removes the buffer for human error. It requires unparalleled precision in how trades are executed, matched, and settled.
Right. If there is any ambiguity in a discretionary mandate, say, the back office realizes a trade might breach the client's risk limits, you no longer have 2 days to clarify the authority or fix the paperwork.
Exactly. It demands absolute clarity on decision-making authority prior to execution.
So, looking ahead, what does the official timeline look like for these structural shifts?
Well, there are 3 strictly fixed, confirmed milestones to calendar. First, the Luxembourg and EU readiness surveys for the T+1 transition remain open until 9 June 2026.
Okay. And the second milestone?
Regarding the new third country branch and third country banking services regime under the Law of 5 May 2026, the transitional provisions will officially apply from 11 January 2027.
Got it. And the final date?
The official market move from T+2 to T+1 settlement commences on 11 October 2027.
Those deadlines really underscore the need for execution-heavy models to have their fundamental mandates in perfect order right now.
Absolutely. Zero room for post-trade ambiguity. Which brings us to how mastery is achieved in practice, the scenario-to-execution narrative.
Right. So the life cycle of a relationship invariably begins with a commercial conversation. You discuss broad goals with your wealth manager.
But the true legal work begins the exact moment that conversation is translated into a clean, documented service model.
The institution must definitively categorize the service as advisory, discretionary, execution only, or a highly specific combination, because ambiguity must be eliminated at the exact point it becomes expensive.
Exactly. The firm must be able to conclusively prove who selected the specific product, who formally accepted the risk, who documented suitability, and who holds the ongoing responsibility for monitoring.
It is all about flawlessly aligning every step of the story. Onboarding, mandate wording, client classification, product governance, and reporting.
If your onboarding file suggests a low-risk tolerance, but your execution records show highly complex discretionary trades without a mandate update, the story is fractured.
And preventing that fracture is the whole point of this excellent framework.
Precisely. Luxembourg is particularly relevant because private banking, investment funds, cross-border clients, custody, and portfolio execution often sit close together, making clear allocation of decision-making authority commercially essential and legally disciplined.
That sums it up perfectly. Now, before we wrap up, I want to leave you with a final thought to mull over. We've spent this entire session discussing the human element, the advisor making a recommendation or a manager making a choice. But as AI and algorithmic trading become deeply integrated into private banking, how will these definitions hold up? I mean, if an algorithm automatically rebalances your portfolio based on a machine learning assessment of your risk tolerance, is that advice or is it discretion? And crucially, who assumes the legal liability when the code gets it wrong? The laws of tomorrow are going to have to answer the questions being built by the technology of today.
Very true. Something to have to think about.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.